Awesome. Okay, let's go ahead and start. All right, so Isaac, I got to thank you and a couple other people just in the past couple of weeks who have reached out to me. I've had a lot of lunches and long conversations with people over the years. It's funny because it seems like every time Bitcoin's price hits the news and it starts going higher, I get people I haven't talked to since high school calling me up saying, "Hey, explain this." I don't get it. Josh, do you mind muting your microphone? If you're not. Okay, can you hear me? Okay, so most of the questions initially are, what's Bitcoin? How expensive is it going to get? How do I buy it? And then how do I sell it to make money? That is not what I'm going to talk about tonight at all. If you're interested in trading, you're going to need to be in the 0.01% of smart people with fast computers on Wall Street, and you're going to stay up all night and you're going to try to beat everyone else in trading. I'm not interested at all in trading. I'm interested in trying to hold wealth for a long period of time. And personally, the best way that I've found is Bitcoin. And I'm going to talk about why that is. So the first question is going to boil down to, what is money? The way that free trade happens organically originally begins with a barter system. I'm sure you guys are all familiar with a barter system. I have apples, you have bananas. We want some of what the other person has, and we figure out what a fair and equitable trade is between the two of us. I give you 1 banana for 2 apples, or maybe it's a 1-to-1. The barter system works great when you are a very, very, very small community, and the specialization that each person has is more or less demanded equally throughout the community. It gets more difficult the larger a community gets and the more highly specified people's job gets. Imagine a bartering system where I am a cobbler, a shoemaker, and I want to buy a house. The price of a house could be, let's say, 1,000 shoes. In a bartering system, it'd be very difficult for me because I would need to go find someone who has a house who wants 1,000 shoes in order to make that trade, and which is next to impossible. So what ends up happening is the free market kind of settles on a medium of exchange, so that instead of me having to go to a person who has a house and give 1,000 shoes to them so that I can get a house, I can give those 1,000 shoes to 1,000 people, or maybe 500 people, depending on how many shoes they want. And they in turn give me an asset that is very, very tradable. It could be salt, bones, cattle, gold. Several different types of monies have ended up becoming money throughout history. And we're going to go over a few of those so that we can understand what the principles of money are. So like I was saying, here are some of the types of mediums of exchange that people have used around the world. We've touched briefly on barter. We're going to skip bone, salt, and cattle, but we will talk about agri-beads and rice stones specifically because their history is really, really interesting, and then we'll move on to other forms of money before we finally arrive at Bitcoin. So like I said, when we go through the barter system, it's fine for a 1-to-1 exchange, but it gets very, very difficult when you try to scale the levels of exchange. Shoes and houses do not have a good ratio, 1,000-to-1 ratio. That's very, very hard without a medium of exchange. And pictured there looks like some gold coins and some green paper money. But you can replace that, again, like I said, with cattle, with glass beads, with all sorts of things throughout history that have been that medium of exchange. I've got a computer. I want some food. Maybe it's hard for me to trade a computer for peppers because I'm going to get way, way, way too many peppers or way too many lettuce for the price of my computer. So I trade it for money, and then over the course of a year, I have enough money that I can every week buy a little bit of food until the value that my computer had is spent buying food. So none of my slides have very much text at all, except for this one. I want to go over these 5 attributes of money carefully. These will reflect throughout the rest of the presentation. The best money, the hardest money, the most honest money works the best when it reflects these 5 attributes well. Money needs to be divisible. It needs to be durable, portable, recognizable, and scarce. If we take some types of money that we've used in the past, let's say cattle. Cattle can be fairly durable, meaning that a cow might be able to live for 20 or 30 years. I actually don't know. I'm just making that up. They're portable because they got legs and they can walk themselves. And when you have a small community, that works well. They're recognizable. Someone's not going to be able to counterfeit a cow by giving someone a goat and pretending it's a cow. It's a very recognizable thing, and you can't easily scam someone out of it. And cattles are reliably scarce in a lot of areas in the world historically that have used cattle for money, but they're not divisible. As soon as you make it divisible, all of a sudden the durability is gone because you've chopped it up into beef and it only lasts so long once it's chopped up and butchered. So cattle has a pretty big problem in being money because it is not divisible. Same thing with, let's say, if someone wanted to use apples as money. Well, apples are pretty small, so a bushel of apples is fairly highly divisible because you can divide it down to one apple, but they're not durable. You can't transport value across time by using apples. You can transport it across space fairly easily, put it on a cart, take it to the next village, but you can't transport it through time because they're not durable. So we see a pattern as we take different sorts of money that have been used throughout history. We see a pattern of 1 or 2 or 3 of these attributes not being reflected very well. And at some point it gets replaced by a newer and better monetary technology. So this must just be a repeat here. Okay, so agri-beads. Agri-beads are very, very interesting. The history is very interesting. They are small glass beads that were used as a currency and a store of value in across West Africa. The glass-making technology in West Africa was very primitive and very rudimentary. So it actually took a long time and a lot of human labor in order to make each of these glass beads. Because of that, they were very reliably scarce. And because they were scarce, people could depend on the market not being flooded with new beads. And as a medium of exchange, they could say, I'm going to take these beads, I'm going to sell a cow, take a certain number of these beads, and I'm going to keep them for a year or 2 years. I'm going to sell some other cows, and at some point, I'm going to buy a house or whatever it was they were going for. However, just because the glassmaking technology in West Africa was rudimentary did not mean that that was the case around the world. And in fact, European glassmaking technology was far more advanced. And it allowed the Europeans to manufacture glass beads identical to this en masse, kind of a form of counterfeiting. What the Europeans figured out is that they could make a shipload of glass beads in Europe, put them on a ship, take them to West Africa, spend them buying human lives, and return with a ship full of human cargo. And we know how that ended. The agri beads are oftentimes called slave beads. You've probably heard of the term. And Before the technology of the Europeans allowed them to flood the market and break the monetary system of the West Africans, it served as a very reliable store of value and transportation of wealth, a good currency and a good money. But as soon as it became unscarce, it broke the money system. And on the backs of breaking that money system rode a lot of the transatlantic slave trade. A lot of the slaves were purchased with counterfeit, fake, soft, easy money because it was very easy to make. There's a pattern there. We're going to come back when we talk about paper currency. So think about that pattern. Another really, really interesting piece of monetary history. Pay close attention to how the villagers kept track of the money here, because it's actually very similar to what Bitcoin ends up being in a digital form. So this type of money was used by the Yapese people on Yap Island in what is today Micronesia. These stones were quarried out of limestone. Limestone was not found on Yap Island, so it was inaccessible on Yap Island itself. So what the Yapese would do is they would go to other islands that were a fair distance away. Guam was actually one of the islands that limestone could be found on, and they would quarry these stones out of the earth, put a big hole through them, and that's actually how they were transported. Some of these stones weighed 8,000 pounds, and it took hundreds of men. They would literally chop down a tree, push it through there, and it would take hundreds of men to pick it up, carry it to a boat, put it on a boat, take it to their island, and then they would install it, as you can see on that picture on the right, they would install it kind of in the village center, the village square. These stones, for the most part, would actually never move again. And the owners of the stone, the village kept track of who owned the stones by each of the villagers having a ledger. So let's say that large stone right there, one of us owned it, and we wanted to buy a house. And someone else valued this stone, it being equal to the house that they had for sale. We would sell it. We would sell the stone. They would sell their house. We would exchange it, and that stone would never move, but the entire village would see the exchange and know that I no longer own the stone. One of you owns the stone, whoever that was. And so the whole villager would keep track on their own individual ledgers. So if any one person tried to cheat the system and say, wait, that's my stone, the entire village would know whether that was true or not, because they all kept their own ledgers of who owned the stones. An interesting side note on this, similar to the agri beads, an Irish American named David O'Keefe ended up being shipwrecked on Yap Island. And he was interested in the abundance of coconuts that the island produced, over and above the abundance of coconuts on many of the neighboring islands. And he tried to strike a deal with the islanders to sell him coconuts, but because David O'Keefe was not a rhinestone owner, he had nothing to offer them as far as monetary value. They didn't recognize his paper currency. They didn't care about gold or silver. They didn't recognize that as money. They only recognized rhinestones as money. And David was not a participant in their open ledger system. He did not have a rhinestone that he could trade. So what he did was, after he was rescued, he went to Hong Kong, bought a ship, tools, explosives, hired a crew, and went to several nearby islands and quarried these stones en masse. And it broke the monetary system of this island. This monetary system lasted for centuries, and he broke it because he broke one of the attributes, which is scarcity. Again, a recurring theme that we'll see. So the silver standard, after the world, different markets around the world had tried all sorts of different things. Much of the world independently, different markets realized that metals, submetals, best exemplified those 5 attributes. And durability was one of the best things, and scarcity. And so for about 400 years, actually, there was what was, today we would call the silver standard. And it started at the fall of the Byzantine Empire, and it lasts until the 19th century. And the Spanish dollar, in fact, was a dollar that was made of sterling silver, nicknamed pieces of eight, or a piece of eight. And it became the de facto international currency for about 4 centuries because the Spanish dollar was minted so precisely that everyone could trust that it had the same amount of silver in every single dollar. The Spanish dollar was the original dollar, and that's actually what the Canadian dollar and the US dollar are actually based off of. The Spanish dollar, interestingly enough, was actually remained legal tender in the United States until 1857. The silver standard was eclipsed by the gold standard. There has been a time, and for a lot of the time that gold has been the standard, there's been kind of a dual standard. But the store of value that silver offered, a lot of that fled to gold when markets realized that gold was actually scarcer and more durable. Gold doesn't tarnish, and it's harder to get out of the ground. And because gold was better on those 2 attributes of money, 2 out of the 5, it was superior to silver, it ended up taking over as the currency of the world, the money of the entire world. Markets all over the world independently realized that gold was superior to silver. At different times when governments have used gold and silver and other precious metals to act as a currency, this was actually pretty famous in the Roman Empire, and many economic historians believe that it helped lead to its downfall, was something called coin clipping, which you guys are probably familiar with. What would happen was the Roman Empire would tax the coins that were in circulation. They would tax just like we have an income tax or a export tax or import tax. And the coins that they received in taxes, they would clip a small amount of coins around the outside, maybe 10% of the coin. And then with that 10%, they would make a new coin. So they could actually increase their spending volume by 10% without having to take that extra in by tax or produce any goods or services for the people. And what they would do then is they would take each of the coins that have been clipped and the new coins, which were the same size as the clipped coins, and they would go and spend them out in the economy, typically to soldiers, but they would spend them as if they were the same as the pre-clipped coins of yesterday. And the people receiving them didn't know any different. And so they would supply the same goods and services in exchange for those coins. And it wasn't until a cycle or 2 that people realized, wait, this coin is 10% smaller. I'm going to charge 10% more for my goods and services. So the people that got the new coins first were not hurt by the coin clipping because they could turn around and spend it before anyone knew that the coins had shrunk. It was the people that got the coins last. Everyone above them had already adjusted their pricing for their goods and services. And so the peasants and the non-asset laborers had to spend their coins at the reduced rate, even though they worked and sold their labor at the higher rate. Not a good way to go. So that's kind of an aside, coin clipping. Gold currently sits at about a 2% inflation rate, which is very good compared to pretty much any other asset that you could try to use for money. Silver has a lot of fluctuation on its inflation rate because most of the silver that's produced every year is actually not produced for money. It's not put into ingots or bars. It's actually used in industrial areas. Gold, only about 7% of gold that is produced each year is used for industrial purposes. 93% is used to store value. So it doesn't have a lot of price noise because it has, industrial demand. If you take out that 7% and gold can't be used for industry at all, it doesn't really hurt gold's price, and it doesn't hurt gold's ability to serve as a store of value. Going back to gold being superior to silver, here's a very quick story. So silver became demonetized because gold just became so superior. Gold's market cap, its market share, was somewhere like 100 to 200 times what silver was very, very quickly once gold eclipsed silver as the base unit of value exchange across space and time. There were a couple of brothers that, trying to find the story here. So since silver is not the hardest form of monetary good available, gold is. In the 1970s, the affluent Hunt brothers attempted to remonetize silver by buying vast quantities of it in the market. This drove up the price initially, and the Hunt brothers believed they could continue driving up its price until they cornered the market. Their intent was to induce others to chase its appreciation and recreate a monetary demand for silver. As they kept buying and the price kept rising, silver holders and producers kept selling into the market. No matter how much the Hunt brothers purchased, the selling and flow of silver continued to outpace their buying, which increased its stock to flow ratio. And we'll talk about stock to flow in just a second. And eventually led to a dramatic crash in the price of silver. The Hunt brothers lost it's about $6.5 billion in 2019 dollars, so probably about $7 billion or so, which is probably the most expensive experiment anyone has taken to try to resurrect a monetary technology that had been replaced by a superior monetary technology. Gold replaced silver, and they spent a lot of money trying to get silver back as money, and it just never caught. So we've gone from agribeads, we've talked about rhinestones, we've talked about silver, we've talked about gold. One of the things that gold suffers in is its portability. Again, it's pretty divisible. You can get gold into pretty small pieces. It's fairly portable. It is heavy, but again, its value is per ounce. And so it really doesn't matter how much you're transporting. It's still going to weigh the same as, let's say, the 1 ounce of gold, 1 ounce of silver. You get way, way, way more value in 1 ounce of gold. And so you can transport more value with the same weight. But one of the things that, it really was cumbersome to transport. So the solution to that was paper money. Now, originally paper money was gold. It was simply certificates for gold. Gold was centrally stored in, Fort Knox or another warehouse. Different central banks around the world had different ways of had different places they stored it, and they would issue receipts for amounts of gold in paper currency. You and I could then take that paper currency and go put it in our pocket, walk down to the market and spend it. And the receiver could spend it. That receiver could spend it. And no one ever really had to go back and physically redeem the paper currency for gold, because once you have the gold, it's hard to transport and spend. But everyone had trust, and they knew that they could, if they wanted to, change that paper into gold at the central bank. Aha, but they were tricked. So several times in the United States, the peg of paper dollars to gold was broken, which was essentially a default by the central bank on its debt. If they issued, let's say, this $20 note, and they said this is redeemable for $20 worth of gold, which could be, let's say, 1 ounce. If they're getting into a tough spot, they say, you know what? Instead of $20 being redeemed for 1 ounce, $20 is only redeemable for half an ounce. So we change the peg to $40 per ounce. which immediately, if you have savings in paper currency, that immediately wipes out half of your wealth overnight. And that happened more than once until 1971, when Nixon said, you know what, your dollars are just not going to be redeemable for gold at all. And that leads us to fiat currency. Now, fiat currency, like we talked with the agri-beads when the Europeans just cranked them out en masse. Same with David O'Keefe with the rice stones when he got superior technology, larger ships and more crew, was able to produce rice stones for much cheaper. It's a form of counterfeiting because it doesn't follow the honest procedures of producing money that those systems had. I mean, the agri-beads were very difficult to make if you use the old technology. The problem is those monetary technologies were not in and of themselves resistant to a superior technology coming in and breaking their money system. So similar to coin clipping, the dollar and any other fiat currency that isn't pegged to anything that is difficult to get can simply just be produced in mass. It's much easier than coin clipping, in fact. And I've got, let me see here. I'm going to bring this back. I've got a little example here of a current US dollar. This was printed in 2017. And this is a silver certificate that was printed in 1957 while it was still redeemable for gold and silver. If I line them up, they're exactly the same size. So once governments figured out how to do paper currency, the coin clipping, no one could detect it. It wasn't like you got paper. This is 10% smaller. So I'm going to charge 10% more for my goods or services. Paper currency was much, much sneakier than that. So once someone has the monopoly over being able to produce a paper currency, inflation occurs. And inflation is nothing more than time theft, similar to the way that the lives of West African slaves were literally stolen because their money system was broken by the Europeans, counterfeiting and inflating the agri-beads. Everyone who participates in a fiat system, their time, a percentage of their time that they give every year in exchange for dollars is literally stolen. And it's not in a way that's upfront. I mean, taxation is still theft in my view, but at least it's upfront and it's done in a more honest way. We are going to take this money from you. You know we're taking it. And if you don't let us take it, we'll kill you. But with inflation, you don't actually know that. You can't see it. The dollars you're getting paid are still the same size. Digitally in your bank account, a dollar is still a dollar, but prices for all the goods and services creep up, creep up, creep up. And just like the people that received the clipped coins last, when they went out to spend it, they realized that they couldn't buy as much, even though they worked just as hard for the coins in the first place. A graph showing this is really interesting because it shows the decline of the purchasing power of a dollar juxtaposed against the currency, the dollar currency in circulation. And we're not just talking about paper money. We're talking about digital dollars. All the money stock is what an economist would call it, the money stock of US dollars. But it gets even more interesting, gets even worse, because if you look at this, that blue line on the far right is the dollars that were created just this year. So if you think inflation's been bad in the past, this is going to be a gut punch. The people that get new dollars first are going to be large financial institutions, similar to soldiers getting clipped coins first. They can turn around and buy up assets at the same price as they were the day before. Days, months, weeks, days, weeks, months, years later, when that money trickles down, when those new dollars, those inflated dollars trickle down to you and I, we will have worked just as hard to receive those dollars, but we will turn around and find out that the dollar we worked for the year before did not transport its value across time as well as we would have hoped. So this brings us through all of this paper currency, fiat, to Bitcoin. And really quickly, I want to revisit one thing, which is what is called the stock to flow ratio. And a stock to flow ratio is a way that you can look at the hardness of money, the scarcity of money. It doesn't look at its portability or its divisibility or anything like that. It just looks at how hard is the money, how scarce is it. The stock to flow ratio takes the stock of existing money and it ratios it against the flow of new money. You can do the same with assets, but it works well with money. So if we take gold, the stock of gold is about $10 trillion. The flow of gold is approximately $200 billion per year. So it's about a 2% inflation rate. So the stock to flow would be roughly a 50 to 1. It's technically about 55 to 1 ratio. 55 stock, for every 55 stock of existing gold, one new piece of gold, one new unit of gold is created every year through mining. The 2020 money stock inflation is about a 5. The lower that number gets, the worse, the less hard or the easier or the higher inflation that money has. So for every 5 existing dollars, one new dollar was created in 2020. And that stock to flow ratio of 5 is absolutely abysmal. Probably even worse than the agri-beads, even though shiploads were being dumped on African shores by European. I bet the stock to flow ratio is still higher than 5 with that. So that does bring us to Bitcoin. And Bitcoin, when compared to gold currently, has a stock to flow ratio that is pretty much identical. It's about 55, so it has about a 2% inflation rate. We will get into mining and the halving rewards in just a minute. But wanted to give anyone a chance to ask any questions. We have not touched on Bitcoin at all yet. I know that's why everyone is here to learn about Bitcoin, but I really felt that I needed to kind of lay that groundwork so that we're all speaking the same language when it comes to money. Does anyone have any questions at all on that? Okay, so we'll hop back in to Bitcoin. Now, like I talked about with the 5 attributes of money, Bitcoin is the next evolution in money technology. Just like gold replaced silver, several other iterations and money technologies have replaced money technologies that existed before that lacked in one or more of these 5 attributes, where a new money technology came in that was vastly superior in any or all of these and ended up replacing it. So Bitcoin wins on its divisibility. It is highly divisible. Every Bitcoin right now can be divided into 100 million units called Satoshis. It is entirely possible for, at some point in the future, for the majority of miners and governing nodes on the Bitcoin network to allow further divisibility. That doesn't actually change the value of Bitcoins itself, but it might allow Bitcoin to be divisible into more than just 100 million. But right now, 100 million is plenty, given that Bitcoin is $20,000, give or take right now. 100 millionth of that, we're talking about several hundred per dollar. Bitcoin is extremely durable. Because it is distributed code, it's distributed information, similar to the way that the Rhinestone ledgers were distributed throughout every single person that lived on the island. There's no one point of weakness or one point of attack. We all know about the sad history of the Library of Alexandria. It got burned to the ground, one of, if not the greatest tragedies in the history of intellectual and historical knowledge losses. If there were 10,000 libraries of Alexandria, there's just no way that the information that was lost when the library burned could have been lost if there were 10,000 copies distributed around the world. That is how the Bitcoin ledger works, is there are tens of thousands of full nodes around the world that have a full and complete copy of the Bitcoin ledger. And there's just no way that that can be lost. Or, I mean, it would be very difficult. Electricity and the internet would just need to go off simultaneously around the world forever. Because even if it went off for everyone and came back on, those nodes could pick up where they left off and keep running. So that's really the only way that Bitcoin can lose its durability, is electricity and the internet are shut off worldwide forever. It's extremely portable. It is literally light, sending vast amounts of value in Bitcoin across the world. You can send $100 million worth for a very, very, very small fee of maybe a few dollars, depending on the network congestion, which we can talk about later. Bitcoin is very easily recognizable, similar to the way that any villager could recognize that a goat is not a cow. Bitcoin is data, it is information, and when presented to the network, when a Bitcoin transaction is presented to the network, the entire Bitcoin network can recognize what it is. You can't spend another currency on the Bitcoin network. You can't try to spend dollars. You can't try to spend another alt currency on the Bitcoin network, because the network will simply just reject it. So if someone brought you, let's say someone brought you gold and wanted to buy your bicycle, it'd be very difficult to figure out if that gold is real or not. In fact, an interesting story just came out of China recently, where over 100, I think it was maybe over $200 billion worth of fake gold was stored at one of the banks, and the bank intentionally used it to leverage hundreds of billions of dollars in loans. And once all of the creditors realized that all the gold in their vaults was literally fake, it was a copper that was with a light gold leaf on it, was fake. All the creditors essentially lost their money because they loaned out against fake gold. Gold is one of the most recognizable monies, but if you and I took a nugget of gold, I have no idea how to truly tell if it's pure gold. You would need some pretty fancy scanning machines in order to do so. There's some interesting YouTube videos that show how gold bars are verified in their purity, and they actually have to smash them into very thin, long pieces and then scan them with a very expensive tool that scans the gold's purity to find out if it's real gold. So Bitcoin is more recognizable than gold, which up till now is one of the most recognizable forms of money in the world. Bitcoin is scarce. With a physical good, a physical asset, there is no way to actually have a perfectly scarce asset. Gold is not perfectly scarce. It's possible in the next generation or two, we could go mine that golden asteroid that's got like $100 quadrillion worth of gold in it. And if we were to do so, gold would essentially cease to function as a reliable store of value that can transport value across time. Because golden asteroid just crashed into Arizona and everyone's got gold now. The only way you can actually have perfect scarcity is in the digital world. There is no perfect scarcity in the physical world, none. Even the most scarce of all assets is not perfectly scarce, and it is possible to create or find more of it. Even though it's very, very difficult, technology can advance and more can be found or made of any physical asset. In the digital world, you can engineer a perfectly scarce asset, which is what Bitcoin is. There will only ever be 21 million Bitcoin. There will not be 21 million and one. It will never go above 21 million. And that is built into the code. It doesn't matter what someone wants to do. It doesn't matter how many people want to mine Bitcoin. There will only ever be 21 million Bitcoin. And that is something that cannot be altered. Okay, I'm seeing chats pop up. Let me see if I can open this. Okay. Okay, so back to digital scarcity. Let's talk a little bit about Bitcoin itself and kind of its built-in protocol and how it works. So we're finally there. Now we're talking about Bitcoin. So in 2009, January 3rd, 2009, an anonymous computer programmer named Satoshi Nakamoto mined the first Genesis block. And I'm going to pull this off of screen sharing and just talk to you guys directly. Satoshi Nakamoto mined the first Genesis block. And what he had done was he had created a code, which I'm not going to get way into at the moment, but he had created a code, a protocol to create a decentralized ledger, very similar to the way that the stones were used, where you just had stones out there, you couldn't really move them, you couldn't steal them. Everyone know who each stone belonged to, and you couldn't cheat the system, because if you were the one guy that tried to cheat the system, everyone else would call you out on it. And in fact, that reminds me, let's do a little experiment here. I don't know who of you guys has been able to get 4 small pieces of paper. Doesn't really matter the size or what they look like. But I'm going to take it from the top here. Section your paper into a quadrant like this. And we're going to take the first 3 people on this chat. Okay, make your paper look like this. Sorry, that's backwards. Isaac, Joshua, Jamie, and Jason. So do that to each of, just do that to your first piece of paper. For simplicity purposes, we're going to give each person 2 points. So it's going to look like that. We're just going to use 2 tick marks as points. And this is going to introduce us to being able to grasp the idea of a blockchain. So if we just take, we'll come back to the beginning, the Genesis block. We'll come back to the beginning of blockchain and kind of delve into that a little bit. But essentially how Bitcoin works is Bitcoin is an open public ledger. Again, very similar to the way that the stones were used back in the day. Everyone knows who owns the Bitcoin or the stones, and you can't cheat the system because everyone has their own ledger. So if you can hold this up to your camera, whoever's got this. Okay. Okay, so we're going to pretend that we can all see everyone's paper and we can verify it. Now, Isaac wants to spend one of his Bitcoin, and he wants to buy a pair of shoes from Jason. At this point, these are really expensive pairs of shoes. So we are going to X out one of Isaac's points. We're going to X out one of Isaac's points and draw it and give it to Jason. Okay. Now, what we're going to do, I'm going to abbreviate and just use, I was going to use first letters, but we got 3 J's. So this becomes a block. Essentially what happens is there are 4 of us. There could be other people that are witnessing this that essentially are running what in Bitcoin would be a node, where they run a complete history of the blockchain and all the transactions. They're going to look at this. They're going to go back and see past transactions and see that Isaac did have 2 Bitcoin that he could spend. And once they see that Isaac did have 2, they recognize that Isaac has signed his private key. We'll get into that as well. He's the only one authorized to spend that 1 Bitcoin. He has chosen to send it to Jason. Jason now has 3 Bitcoin. So our next block will look like this. Isaac has 1. Let's see, Joshua and Jamie still have their 2, and Jason has 3. Now what happens is the previous block, the next block attaches to that previous block. Once this second block is attached, nobody can go back and make any changes to this first block. And everyone knows what's going on here. If Isaac sends like a message to the network and says, you know what? I want 2 more pairs of $20,000 shoes. I'm going to spend 2 Bitcoin and get 2 pairs of shoes from Jason. The network's going to look at it and say, no, you only have 1 Bitcoin. You can only spend 1 Bitcoin. You cannot spend 2. And so we can keep adding additional blocks that take in those transactions, and that essentially becomes a blockchain. And every time a new block is added, it makes it so the previous block is immutable. It cannot ever be changed. So the way that Bitcoin works is every 10 minutes, a new block is added, and all of the transactions that people want to go through during that 10-minute time period are added to that block, locked up, and you can't change it. Isaac cannot get that Bitcoin back unless Jason freely decides to send it to him, because now Jason has full control over those 3 Bitcoin. So looking at it this way, when you are, sorry, I didn't screen share this. Let me screen share this again. We are comparing a decentralized ledger system to a centralized one. Let me go through these slides and get to the right one. Okay, so the traditional system, and we can go back to our fiat system, is there is a central bank, or let's say Visa. Visa is a centralized system. If one of the participants in Visa wants to send money, Visa has the complete control to say yes or no to that send. Also, Visa can edit that later on. They can turn it around and undo it. They can void it. If the government says that there's a bad person trying to buy drugs, Visa can just cancel their card altogether. There's all sorts of things that a central system can do. And centralized banks for a long time have done that. To a lot of people, if you look in Hong Kong right now, a lot of the Hong Kong freedom fighters and protesters are getting their accounts completely frozen, all of their debit and credit cards canceled and frozen, and their funds in that centralized system completely frozen. They can't move it. In a distributed system, there's no one person that is in charge of this ledger. So no one person has an undue amount of authority to modify any transaction. So just again, going back to the stones on the island that never moved, but everyone knew who owned them. It's kind of like the way Bitcoin works. Is it's an open ledger system, kind of, with our experiment within the game of Monopoly. there's a rule that if the bank runs out of money, you literally just take a piece of paper and keep track of the amount of money that everyone has. And every person in the game of Monopoly can see every single change. And if someone tries to make a change and add $10,000 to their sheet, all the other players will reject it. And unless that player goes back and does it honestly, that transaction that they're trying to create will be removed from the system, and they'll eventually be kicked from the game or the network, which is similar to the way that Bitcoin operates. So in a decentralized system with a distributed ledger, any person can broadcast a transaction to the open ledger, just like an islander could say, hey, village, I am spending this stone and buying that horse. And the whole village sees it. The whole village accepts it. And now you own the horse and you do not own the stone, and the whole village knows it. You cannot go spend that stone again because the village would just reject that transaction. And if you keep trying, I don't know what they'll do, kick you from the society, kick you from the network. So that's a very, very, very basic view of the way blockchain works and the way it works as far as a distributed system and a distributed ledger. I think looking at the Bitcoin network as this ledger system, like we're putting our papers together, we all know what each other has. We can all see if Jason tries to spend more Bitcoin than he has or more points than he has. Everyone knows how many he has, and we're just going to laugh at him if he tries to buy more shoes because he just doesn't have it. He's going to have to go out and get more points in order to spend it appropriately before the rest of the network will allow that spend. So the network is very anti-fragile. It weeds out bad actors very quickly, and you can't hack it. You can't fraud the system, just like you couldn't pretend that stones that weren't yours on the island were yours and try to spend it. Okay, so that's another pausing point. I don't know if anyone has any questions up to that point. Where did my chat window go? Okay, so does anyone have any questions at all? Okay, so I'm going to talk a little bit about the mining and the stock to flow ratio of Bitcoin. Under the scarcity, oh shoot, am I sharing the screen? I'm not.
No.
Okay, so the fifth attribute of this being scarcity is the part that all of the other money systems that we've talked about broke, is with the scarcity. The aggregates, the stones, whatever it is, even silver, the scarcity lost out to gold having a superior stock to flow ratio. Okay, so going back to 2009, January 3rd, 2009, Satoshi Nakamoto mined the first block. Now, every time a block is mined, so these pieces of paper that we've used, every time a block is mined, there's a block reward. And the way that these block rewards are given is cryptographically. Bitcoin operates off of what's called a SHA-256 cryptographic system. Every time a block is completed, all the transactions are completed roughly every 10 minutes, and there's a difficulty adjustment we'll talk about. There's a new block that's out there that has to be, quote unquote, discovered or mined. And there are tens of thousands, probably hundreds of thousands or millions of computers now, specially designed computers that are just created to try to solve these very complicated cryptographic math problems. Calling them math problems is not actually true, because With a math problem, there is a logical way of solving it. With cryptography, you cannot logically solve it. The only way you can get the right answer is guessing. Guess, 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 until the system says that's the right answer. And so these mining nodes, these computers all over the world, are rushing every 10 minutes. They're trying to guess the answer that will allow them to mine the next block. It costs a lot in equipment. It costs a lot in electricity. It's called proof of work, meaning that if you are going to mine a block and verify the transactions, you have a lot riding on you doing it correctly. Because if you don't do it correctly, you've wasted all of that product and electricity trying to mine a block that the rest of the network says, nope, you're trying to cheat the system. You're out, and you don't get any reward. The block is a fork that dies, and you're going to need to correct your behavior in order to come back into the system. So again, every 10 minutes, a block is mined. These computers are rushing to solve the next block. Once the next block is solved, the previous block becomes completely immutable. And every 10 minutes, every 10 minutes, every 10 minutes. So the amount of the flow of new Bitcoin into the stock gradually decreases every single year, gradually, and then suddenly every single year, the reward for finding the next block or solving that math problem gets cut in half. And from Jason's question, how many of these am I going to do? I am going to need to split this up into 3 different presentations. This is going to be the last bit on this one, because getting into how to safely store the different types of wallets that you can keep Bitcoin on, transaction fees, things like that will need to be another presentation. So this will take about 5 minutes longer to get through the rest of this. And then for those interested, I will put together another presentation to get more into how to self-custody Bitcoin and security and other things. But quickly back to the mining block. Every 10 minutes, a new block is created. During the first, and every 4 years, the reward for the block being found is cut in half. So for the first 4 years, every block that was created every 10 minutes, there were 50 Bitcoin that were awarded to the computer that solved that block, that guessed it correctly and was able to lock that block into the network. 50 new Bitcoin every 10 minutes. The stock was increasing like crazy. That did not work as money at all, but that was by design in order to build up the stock quickly and then to slow the flow so that eventually it would start acting more like a scarce money. So for the first 4 years, there were 50 Bitcoin every block. The second 4 years, that was cut down to 25. The third 4 years, that was down to 12.5. Currently, we are at 6.25 Bitcoin per block. In the first 10 years, we're 11 years now, of Bitcoin's existence, about 18.5 million Bitcoin have been mined. The remaining, which is about 85%, I don't know if I'm doing the math right there. The remaining 15 million is going to take about 120 years, because every 4 years that stock to flow ratio gets doubled. The reward gets cut in half. So right now we're sitting at about a 55 stock to flow ratio. So for every 55 existing Bitcoin in a given year, 1 new Bitcoin is created in a given year. Once that gets halved again, we're going to be in new territory, because the hardest money with the highest stock to flow ratio we've ever had is gold, which has been roughly 55 on the stock to flow ratio, roughly 2% inflation. So in 3 years, when that halving occurs again, and our stock to flow ratio goes from 55 to 110, we're in new territory. We've never had money that was harder than gold being at a 55 stock to flow ratio. So that's completely new territory, which is going to be really exciting to see what happens once we have money that is harder and scarcer than gold, which has been the hardest and scarcest up till then. So I've got a question from Jamie. And she's asking, what happens to lost Bitcoin? Lost Bitcoin is lost. It is gone. Estimates put the amount of lost Bitcoin up till now between 4 and 6 million coins, which means that even though there will only ever be 21 million coins ever mined, and that will be the cap, effectively there will probably be more like 15 million that will be available. For the first couple of years, Bitcoin was essentially worthless. The first transaction that Bitcoin was ever involved in was buying 2 pizzas at a cost of 10,000 Bitcoin. I don't know the math, but 10,000 times 20,000 is what? 200 billion, I don't know, 20 billion, whatever it is. It's a huge number. Start adding all those zeros together. At that time, Bitcoin was essentially worthless. And so a lot of people didn't really custody it correctly. You've got thousands of Bitcoin that are worth maybe $1 or $2 on a computer, and you get rid of the computer. Those Bitcoin are gone, and they're gone forever. There is no way to get them back. Bitcoin works off of, this will be the last thing I'll mention before we really start, before I talk about how you can actually buy it, and then we will pick this up at another time on how to custody it. But Bitcoin works off of what's called private public key cryptography. It's kind of like email, where you have an email address that everyone knows, but you only know the password. So anyone can send you an email because you can publish your email address on the web, on Facebook, on social media, whatever. Everyone can know what your Bitcoin address is or what your email address is, but only you know the password. Anyone can send you an email, only you can send emails out. It's the same way with Bitcoin. There's a public key, which works like an email address. Then there's a private key, which works like a signature or a password that only you know. You got to keep it safe, because if you lose that, your Bitcoin is gone. You can log into the Bitcoin network and you can look at a wallet and you can see how many Bitcoin are in there, but you can never move that Bitcoin if you do not have the private key or the signature. So there is a lot of Bitcoin that's lost. Losing Bitcoin nowadays is extremely rare because of its value. People are incredibly careful with it. They treat it, instead of treating it like sand, they treat it like gold. If gold were valued like sand, no one would care. You'd lose sand everywhere. But gold being valued as gold, it's very, very rarely lost. Most all of the gold that's ever been mined in the world throughout history is still held in custody. People still have it. There's not much gold that's been lost. So as Bitcoin increases in value, losing Bitcoin or losing those private keys will become rarer and rarer as people are more educated with its security. That's a very, very good question, Jamie. And that does essentially create that 21 million hard cap, as it's actually lower than that. It's about 15 million, give or take. It's hard to know for sure. Okay, so we've talked about the block reward, difficulty adjustments in mining. This is really important. If you look at gold or silver, and let's say that a huge amount of people wanted to go and mine gold. Let's say half the population of the world, all of a sudden, overnight, wanted to go mine gold. If that many people got into gold mining or silver mining, the amount of new gold and silver produced would skyrocket. I mean, it would be incredible, because there is so much gold and silver in the earth. It's just hard to get. But if you put enough people, the amount of gold that comes out of the earth every year will shoot through the roof. And that will disrupt the supply side of gold and silver. With Bitcoin, Bitcoin has a built-in algorithm within the code that automatically adjusts the difficulty of each math problem. We're calling it a math problem, but each cryptographic puzzle that is needed to be solved in order to unlock the next block. If more miners are put onto the network, those blocks, those questions will be answered, those cryptographic puzzles will be solved quicker. So what the difficulty adjustment does is every few blocks, it looks at how quickly these puzzles are being solved, and it either ups the difficulty or downs the difficulty in order to keep that block being solved, a new block being solved approximately every 10 minutes on average. So if all of a sudden you double the amount of miners on the system, you would think that you would cut in time by half the length of time it costs to solve a new block, which you would essentially double the amount of new coins coming out, because instead of a coin being 10 minutes to solve, costs 5 minutes to solve, but you still get that full 6.25 out of the block, which is true if you double the amount of miners on the network for a few blocks. Those blocks could be solved in 5 minutes instead of 10. But after a few blocks, the algorithm will automatically adjust, and it will make it so that the next block is twice as hard to solve, and it will put that block time back to 10 minutes. And so it's been remarkably accurate. If you look at the history of how blocks are created, it's remarkably been able to keep a 10-minute interval between those blocks. And that's why we can very, very, with a high degree of confidence, predict that the last Bitcoin that will be mined won't be mined until the year 2140, because we can predict the blocks that will be mined in the future. So in 3 years, that reward difficulty will be cut from 6.25 to 3.125. And then in 4 years, it will be cut again. And it will be increasingly harder and harder money. Rather than the way the Federal Reserve prints more and more dollars every year, and the inflation rate actually accelerates and it becomes softer money, it loses its ability to transport value through time. Bitcoin will actually gain ability to transport value through time, because its stock to flow ratio will increase every 4 years, and it will be harder and harder to get new Bitcoin into the system. Okay, questions on that? I know it's a very basic, it's an undetailed explanation of how blockchains work. I hope the little demonstration with the papers kind of helped you guys understand the blockchain and how it is a public ledger, which is why it's essentially unhackable, because everyone who is running a full node wallet around the world has the complete blockchain history, and anyone who tries to spend Bitcoin that isn't in their wallet will be kicked out of the system. There's no way to fraud the system and duplicate, spend money here, spend money there. You can't spend the same Bitcoin twice from the same wallet. Okay, any questions on that? Okay, so the last thing we're going to talk about is, how do you acquire? This is going to segue into another presentation that I will talk about the best ways to buy Bitcoin and store it, because storing it is a whole another thing. And I want to be really careful when I talk to people about how to store crypto, specifically Bitcoin. So I would recommend going through the Cash App. Cash App is owned by Square, which is Jack Dorsey is the CEO of Twitter and Square. Whether you think Jack Dorsey is a good guy or a bad guy politically, he kind of censors a lot of stuff. It's a very it's a company that you can reliably trust with, buying Bitcoin. It's not some seedy startup. Same with Coinbase. Coinbase is a multi-billion-dollar trading company. Swan Bitcoin is a newer one, but very, very reliable. I would recommend going to one of those three. There are others, Kraken, Uphold. There are a bunch of other ones that are probably equally as good. But those three, for simplicity purposes, is what I would recommend.
What was the third one? Cash App, Coinbase, and what?
Swan Bitcoin. And I'm sorry, I meant to share this screen here. There you go. Cash App, Coinbase, Swan Bitcoin. Because I'm very anti-trading, the people that are trying to trade either are the smartest people in the room or they're going to lose their shirts. If you try to time the market, buy low, sell high, it's just not going to work for you. Pretty much everyone that I know, myself included, their biggest regret at any point during their involvement in Bitcoin is that they ever sold any. Because if you sold any, prior to today, if you sold any, you would have lost value. So yeah, don't sell. A tip is to avoid Robinhood and PayPal. The reason for that is because Robinhood and PayPal are offering Bitcoin in the same way that central banks offered gold receipts, but you could never actually take the gold out of the bank if that were the rule. So if you buy Bitcoin on Robinhood and PayPal, you can spend it within their system, but you can never actually take your Bitcoin off of those exchanges and self-custody it in your own wallet. The only way you can spend your Bitcoin in PayPal is to go through PayPal as a payment rail. So they will always own your Bitcoin. If you buy $100 on PayPal, they actually control it, and you can never get that Bitcoin off of their system and use it yourself. Same with Robinhood. So although I do think that it's a good thing that they are offering it, just because it will expose more people to Bitcoin and say, hey, I can buy Bitcoin at PayPal, will kind of make it a little bit more mainstream. You cannot take self-custody of your Bitcoin if you buy it on one of those two platforms. And within the Bitcoin community, there's a popular phrase that is not your keys, not your Bitcoin. If you don't control the private key, then it's not really your Bitcoin. It's someone else's that you kind of has to ask permission to use. So you guys are a little bit beyond just being basic beginners at this point. So go ahead and skip the Robinhood PayPal thing and just buy your coins directly on one of these exchanges. From there, again, this is going to be another presentation because it's going to be another hour when we talk about custodying. But in brief, to give you kind of a preview of it, you can buy Bitcoin on Cash App and you can leave it on the Cash App. That is called a custodial wallet. You are leaving your Bitcoin in someone else's custody. You have a username and password that you log into Cash App, and you can sell it or send it to someone else, similar as you can do it with Venmo or within Cash App, since it is a competitor to Venmo. But when you log in and you send it, a third party can stop it. They can freeze your account. They can decide, oh, you're a bad actor. We're not going to let you use our services. So that's the first type of wallet, is called a custodial wallet. That is really how you have to get introduced to Bitcoin. Right now, with all the new regulations, there's really no way to get Bitcoin easily. So you need to go to one of these established exchanges, go to the Cash App, you buy $100. That Bitcoin is on the Cash App. It is controlled by the Cash App. It's your Bitcoin, but you don't control it yet. The next step is you can withdraw it to what's called a hot wallet on your phone. At that point, you completely control your Bitcoin. Within that wallet is the private key. You can send it, you cannot send it. No one else can tell you what to do with your Bitcoin. It's called a hot wallet because it's always connected to the internet and it is on your phone. So even though the wallet cannot be hacked itself, if someone were to take possession of your phone and, let's say, know your password or somehow hack into your phone itself, they could theoretically spend or otherwise take control of your Bitcoin on a hot wallet. So a hot wallet is preferable to a custodial wallet because you control it, but it does have some amount of risk. The next step in security is going to be a cold wallet. Cold wallets are wallets that you can, a USB drive, specially manufactured, cryptographically protected. or even a piece of paper. You can actually print out a Bitcoin wallet on a piece of paper. It's essentially just your private key that can either be in a QR code or the actual private key that's 250 bits long. And you can fold that up, put it in a book, and no one can hack it because it's not connected to the internet. It's completely unhackable. Someone has to physically come into your house, find it, and take it. So that is really the highest level of self-custody and security that you or I, as individual people, would really need. And that's another lesson I will take people through, how to actually withdraw your Bitcoin from your custodial wallets, either into a hot wallet first or directly into a cold wallet, and how to make sure that you keep those very secure. But again, I don't want to rush through that, so I'm not really going to get into the weeds on that one, just because security and self-custodying your Bitcoin is probably the last thing I want to rush through. But you guys can get started. If you want to download the Cash App, you can pretty much immediately buy $10, $50, $100 worth of Bitcoin. My suggestion would be to do what's called dollar cost averaging. You set an automatic buy on a daily, a weekly, or a weekly basis, and you just set it and forget it. The last thing you want is to have fake, funny money, monopoly paper money sitting in a bank account, losing value every year, hemorrhaging value. The inflation rate is well above 10% a year at this point. Again, we saw the graph, 22% of dollars in existence were printed this year. The inflation rate is going to kill people's savings in the very near future. It's already decimated people's savings. In one generation, from 1965 to today, the dollar has lost 97% of its value. So if someone had a savings account that they wanted to pass on to their grandkids, send them through college, they would only have 3% of the value that they had worked hard to save from 1965 till now. So the last thing you want is for your money to be sitting in fake fiat money, losing value every year. Whether Bitcoin is ultimately successful or not is risky. I'm a big believer, but whether it will succeed or not, you can be 100% guaranteed that your paper dollars, whether it's in the bank account or under your mattress, are going to lose value every single year. That's a guarantee, an absolute guarantee. So I do honestly make a very strong suggestion that people take an amount of money that they just want to set aside. It could be $10 a day. Get it out of the fiat system, get it into something that there is risk, but at least there's risk to the upside. With the dollar, there's no risk to the upside. It's all downside risk. There's never going to be a year where the dollar will gain value for you, ever, 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 ever. Never has happened, never will happen. It will always lose value. Bitcoin, it could lose value, but the fact that it has an upside risk is an asymmetrical risk that I strongly encourage everyone to really think about allocating a portion of their savings into Bitcoin, just so that it doesn't have that guaranteed loss of value every year. And that's my pitch. Again, sorry, I didn't really get into a lot of the technicals of Bitcoin. I really wanted to lay that foundation of money so that people can understand why Bitcoin has value, and why it is the next evolution in money technology. Without that understanding, Bitcoin is just internet money for nerds. And why in the world would I put my hard-earned dollars in something like that? So hopefully with that understanding, you guys can have a little bit of a stronger foundation to risk your hard-earned dollars that are losing value and put them into something else. Questions?
Jamie wants to know when the next session is.
Good question. I put this slideshow together today from scratch. So the next session will be a little bit more technical, and I do want to very carefully walk people through public keys, private keys, seed phrases. That's something you can do homework on. What is a seed phrase? Very important. The different kinds of hot wallets and the different kinds of cold wallets. I would love to do it again next weekend at 6 p.m. on either a Saturday or a Sunday. That would give me enough time to put something together that I would feel comfortable with. Because again, we're talking about being your own bank and custodying your own money. Being your own bank is very liberating, but it carries a high degree of responsibility and risk that only falls on you and no one else. So I want to make sure when we're talking about how to custody Bitcoin correctly, that we're doing it correctly. Because like Jamie said, what happens to lost Bitcoin? You're never going to get them back. They're gone forever. So.
Nelso asked a little while ago if you could break down the different coins. So I don't know if you want to do that tonight or if you want to do that on another session.
Yeah, so I'm actually not ever really going to get into breaking down the different coins within crypto. This is how I will break it down for now, though. The way to look at crypto in general, there are tens of thousands of coins. The only real healthy way of looking at it is to divide cryptocurrencies, crypto into three different categories: crypto assets, cryptocurrencies, and crypto platforms. Bitcoin is a crypto asset. It is the crypto asset. There is no other crypto asset that offers the store of value across time the way Bitcoin does. I mean, it's it. There's not a competitor within that sphere. If you're looking at saving your wealth long term, Bitcoin is it. It is the gold. There is not a second kind of gold like silver. The market cap for silver is like $50 billion. The market cap for gold is 10 trillion. Bitcoin is like gold in being a crypto asset, and it is it. That's all there is. Within cryptocurrencies, you do have a lot of different cryptos. Cryptocurrencies are much more easily spendable. They have low network fees. If you want to do your own research into that, I do have a couple of my personal favorites like Dash and Monero for privacy and ease of use, but I'm not really interested in talking about cryptocurrencies at all because it's not necessarily an incredibly good store of value on the long term. They are more risky. There are smaller market caps. There's a much, much, much smaller network effect. Those other cryptocurrencies are kind of in the realm of maybe a MySpace. It's kind of a cool idea, but it's not big enough to be the dominant network. It's not Facebook. Facebook doesn't really have a network competitor like MySpace did. MySpace got eaten up, spat out, and it's gone. Bitcoin is to the point where it has so much mining energy, so much network effect. It's the only asset. It's the only way to store your wealth across time. If you want to experiment with other cryptocurrencies, you are dabbling into how to more easily transfer your wealth across space, which is a fine thing. Bitcoin is a little bit slower, 10-minute blocks. Your transactions will clear every 10 minutes. You can't stand at a cash register and buy a cup of coffee. Sometimes the network fees do cost a few dollars. So if you're trying to buy a $2 cup of coffee and the network fee is $4, it's going to cost you $6, and it might take you half an hour sitting at Starbucks if you want to use Bitcoin. So Bitcoin is not really a great currency. It's not going to be a great currency as far as its inherent blockchain capabilities. But it's similar to gold. Gold is not a great currency. It's heavy, it's clunky, but it is a fantastic store of value, and Bitcoin is a better store of value across time. And as long as you're moving the right amount, if you're moving $100 or $1,000 or $10,000, the fact that it takes a few minutes and costs a couple dollars is incredible. There's no other system that offers that in the world today. So that is what I'm interested in. That's really all I will talk about. And then the last one is crypto platforms. This is your Ethereum, your Neo, your other crypto platforms. It's really up in the air. The market hasn't decided how to value these things. There's no hard cap on a lot of them, like Ether. There's no hard cap. There will be new Ether every single year in perpetuity. So it's not like there will only ever be this 21 million units. So I don't know how well of a store of value it's going to be. They don't work as good as cryptocurrencies for transactions, but you can do some really cool things on these platforms, smart contracts, some other things that are being experimented with. But as far as cryptocurrencies and crypto platforms go, do your own research, find what you are interested in. The only thing I'm interested in is preserving my hard-earned wealth for the long term, and Bitcoin is really the only thing that offers that store of value across time. Even though, there are others that offer it across space. I mean, the dollar, the Venmo is fantastic. You can transport value across space. There's no problem with that. There's no market need to create money that is better at transporting value across space. Doesn't exist because the dollar is so easy to use. Most fiat currencies are very, very easy to use. Credit cards, Venmo, whatever, you can transport value across space. It's transporting value across time that is really where we need a fix in money, a new technology to allow us to do that. That's what Bitcoin is. So that is what I'm going to be talking about. So the other question is, I've heard Ethereum is better than Bitcoin. Like I explained, they are two completely different things. And I'm not really going to get into, you can research the differences. There's going to be a lot of people with opinions, but it's kind of like comparing grain to gold. Like, well, you can do some things with Ethereum that you can't do with Bitcoin. You can eat wheat. You can't eat gold. But if you're going to dump $1 million into a store of value that you hope your grandkids can inherit, you're not going to buy grain. You're going to buy gold. So if you are wanting to do other things than store your value, and you want to look at other cryptos as having tools to do other things than store your value, then Ethereum, other things can possibly offer that, but I am only going to be talking about how to store value, and Bitcoin Core BTC is it. So I think that'll wrap it up tonight. And I will see if I can put something together throughout this next week so that I can comfortably show you guys how to custody your own Bitcoin. Again, if you want. If you trust Coinbase and Cash App and you don't trust yourself with the private keys, you might lose them. It's fine. It's better to have exposure to Bitcoin and keep it on a custodian wallet like Cash App than to have no exposure at all. I think that custodying your own coins is better, but if you're not ready for that, custodying it on an exchange is still better than not being exposed at all. So Saturday or Sunday, it'll probably be Sunday again. 6 o'clock, same exact thing as tonight. And we'll talk then. And I can show you guys some, 5 o'clock your time if you're on Pacific time, 7 Central, 8 Eastern. So, okay. Thank you guys very much for joining. And it's always fun. I always love talking about Bitcoin and how to hack the fiat system and get around it and not keep your wealth in dollars and not watch it vanish every year, but possibly watch it grow. So that'll be it. Josh, I think you're the host. Thank you, Jamie. You great questions. Nelson, good questions as well. We'll leave it at that, and I will send out an invite. I'll put some together. I'll let Isaac and everyone else know, and we'll do this again next week.
All right, I am ending the meeting.